Two people, same amount of money. 20 years later, one has a paid-off rental property. The other has a stock portfolio worth $500,000. Which one actually came out ahead? The answer is going to surprise you, because most people pick a side based on opinion. We're going to pick a side based on math. Meet Alex and Jordan. Both have $50,000 saved up. Both are ready to invest. Same starting line, very different game plan. Alex uses his $50,000 as a down payment on a $250,000 rental property. He takes out a 30-year mortgage at a 6.5% interest rate. His monthly mortgage payment lands at around $1,580. He rents the property for $2,000 a month. On paper, that's a $420 monthly profit, but here's what the internet doesn't tell you. Maintenance typically runs 1% of the property value per year. That's $2,500 annually. Vacancy periods. Because no property stays rented 365 days a year, eat another 5 to 8% of rent. Then there's property tax, landlord insurance, and occasional big repairs. Jordan does something completely different. She puts all $50,000 into a low-cost total market index and leaves it alone. Historically, the US stock market has returned an average of around 10% per year over long periods. She sets up automatic monthly contributions of $300 and doesn't touch it. So here's where we stand at the starting line. Same $50,000, same 20-year timeline, but very different journeys to get there. The first 5 years for Alex are, honestly, harder than he expected. Year 2, the water heater dies, $1,200. Year 3, a tenant moves out and the unit sits empty for 6 weeks. That's $3,000 in lost rent. Year 4, a roof inspection reveals damage, $4,000. These aren't rare events. These are just landlord life. After factoring everything in, his real net cash flow in the first 5 years averages closer to $150 a month, not $400. Jordan's first 5 years look very different. The market has good years and bad years. She doesn't panic. She doesn't sell. She just keeps contributing that $300 every month. By year 5, her portfolio has grown to approximately $95,000. But here's what Alex has that Jordan doesn't. His property has appreciated. The house he bought for $250,000 is now worth around $285,000. That's $35,000 in equity growth, on top of the mortgage he's been paying down. Leverage is powerful, but it cuts both ways. By year 7, Alex refinances. Rates have dropped slightly, and his equity has grown. This lowers his monthly payment and improves his cash flow. He's also raised rent to $2,200 a month, keeping pace with local inflation. His monthly profit after all expenses is now averaging around $300. Not life-changing, but it's becoming more stable, and his property is now worth approximately $310,000. Jordan hits a milestone around year 8 that changes everything visually. Her portfolio crosses $150,000, and this is where compound interest stops looking like a slow crawl and starts looking like a curve. The money she made is now making money. Her original $50,000 has more than doubled, and she hasn't had a single midnight emergency phone call about a broken furnace. Let's pause and compare at the 10-year mark, because this is where people usually declare a winner too early. Alex's property is worth around $320,000. He still owes roughly $190,000 on the mortgage. That gives him around $130,000 in equity. Jordan's portfolio is sitting at approximately $187,000, fully liquid, no debt attached, no maintenance required. On paper, Jordan is ahead in net value, but Alex has something Jordan doesn't: a hard asset that someone else is partially paying for every month. Here's a factor the math alone can't capture, and it might be the most important one: behavior. When the stock market drops 20%,